If you want to replace your job's paycheck with investment income so you don't have to keep going to work to get paid, you're in the right place because I'm going to show you the 5 assets you need to buy to make it happen. If you make $80,000 a year from your job, you need to make $80,000 a year from your investment income to be able to quit your job and live your life without changing anything you're doing. With your job, you have to go into work every single day to keep getting paid. With your investments, once you put your money to work, it'll keep paying you even if you're not working. Most financial advisors would tell you just dump your money into the S&P 500 to build your wealth. Now, that's not a bad thing. I also invest some money into the S&P 500, but when we talk about creating income, you need an income coming in. That way you can use this income to pay your bills. So with that, let me go over the 5 assets you can consider investing your money in. That way you can actually create an income to replace your job income. But full disclaimer, this is not going to be easy. It's not going to happen overnight. It's going to take money and it's going to take sacrifice. But if you're willing to put in the work and stick with it, it's 100% possible. And I'm going to go from the easiest to the hardest. So let's jump right in. The simplest way to start creating income from your investments is by investing money into Treasury Bonds. This is where you lend money to the United States government and they're going to pay you regular interest payments for using your money. Before I show you how this works, let me start with the pros of this, which are number 1, it's generally risk-free. If you're lending money to the United States government, it's backed by all the taxpayers and it's backed by the Federal Reserve Bank's ability to print money and lend it to the United States government. Because if the United States government were to default and not pay their bills, that would create a global crisis, and the least of your problems would be your treasury investments that you made. The second benefit is the interest that you generate from these treasury bonds are generally not subject to state taxes, which means you get to keep some more of that income, unlike putting your money into, say, a high-yield savings account. And number 3, you can create a new stream of income that can be paid to you monthly. I'll show you how, through these interest payments that you get. But what about the cons? Con number 1 is you don't get any growth in your principal. So if you lend $100 to the United States government, you're going to generate interest on those $100, but that $100 doesn't actually grow. You're just getting interest on that $100. Number 2 is you get lower-ish returns because you're capped based off of whatever the interest rate is, and because it's generally risk-free, you're getting lower returns because you're not taking on a whole lot of risk. And number 3, this is not FDIC insured. You have no guarantee that the government is going to pay you. It's just the promise that the United States government is going to pay you. So how do you do this? Well, you can buy these treasury bonds directly from the United States government by going through Treasury Direct, or an even simpler alternative would be to invest your money into a treasury bond ETF like SGOV. This is an ETF that's investing in treasury bonds, meaning lending money to the United States government with loans that are going to mature in 3 months or less. And at the time of me recording this video, SGOV is paying out an annual dividend of around 4.7%. But this is the part that you have to remember. When you're investing in treasury bonds, even a treasury bond ETF, you're not investing for growth of your principal. So what you'll see is that the SGOV ETF price really doesn't change. I mean, the only time it goes up and down is when it pays out the dividend, because the stock price will fall by the amount of the dividend, but the stock price, the ETF price, stays the same, and then you get this interest, which right now is around 4.7%. It's paid monthly, but the way that you get paid is through that interest. So this is a relatively simple way to create monthly income that's generally pretty stable, and it's backed by United States treasuries. Again, the difference between this and putting your money into a high-yield savings account is even with this ETF, if you invested your money here, you're generally not going to be subject to state taxes, versus with a high-yield savings account, you're going to be FDIC insured, but you will have to pay the federal and the state taxes with that. And of course, you should also be aware that the interest rate that these treasuries will pay will depend on what the Federal Reserve Bank is doing. So if the Federal Reserve Bank cut interest rates, well, these treasury interest payments will also probably fall, but that's a topic for a different video. Asset number 2, which is a little bit more advanced, are dividend paying ETFs. There are some companies in the world, for example, McDonald's, which has the stock ticker symbol MCD, which is making billions of dollars of profit every single year, and then they don't know what to exactly do with that profit. So one of the things that they do is they just give it away to the shareholders. So if you buy 1 share of the McDonald's stock, you are going to be entitled to your share of profit distribution, which is called a dividend. This dividend is paid out every 3 months, meaning every quarter. The problem with investing in, say, McDonald's or another dividend-paying stock is What happens if McDonald's starts to serve bad burgers? They start to take on too much debt. They hire a bad CEO. They run the company into the ground. And now not only maybe they cut their dividends, but they also go bankrupt. Now, not only did you lose your income, but you also lost your entire investment. Now, it's not a bad thing to invest into individual companies, but that's a little bit more advanced, and you want to make sure you're staying up on your research. This is why the alternative and a much simpler way to start if you want steady, consistent income without the headache, without all the research, without all the work, is to consider investing your money into dividend-paying ETFs. Now, I got to give you a disclaimer, okay? Investing has risks. You are never guaranteed to make money when you invest. In fact, you will lose money at some point, so make sure you always do your own due diligence and never blindly trust a random guy on YouTube. I'm going to break this dividend section up into 3 different categories. And instead of investing in an individual company, you can invest in a fund, a basket of stocks called an ETF. Now, instead of investing in one company like McDonald's, you can invest in a dividend-specific fund that's giving you exposure to things like, say, high dividend-paying stocks in the United States. And now maybe you're going to get exposure to hundreds, maybe thousands of high dividend paying companies. This way, if one of the companies, say McDonald's, goes bankrupt or really starts to struggle, this ETF will kick that company out and replace it with another company. That way it's completely passive for you and you can continue getting at least some sort of steady of an income. Example number 1, NOBL, Noble. This ETF will give you exposure to S&P 500 dividend aristocrats. What that means is this is dividend paying companies in the S&P 500. The S&P 500 is a group of the 500 largest companies in the stock market. Not all of them are going to pay a dividend. This is going to invest in the dividend-paying companies in the S&P 500, but more specifically the dividend aristocrats, meaning these are companies that have paid out and increased their dividend every year for the last 25 years or more. If you want to get exposure to all those companies, well, this ETF will give you exposure to that. And at the time of me recording this video, Noble is paying out a little bit over 2% a year in dividends. But let's say you wanted to get a little bit more broad. SCHD is an ETF that I'm personally invested in. As a disclaimer, this is created by a company called Schwab, and this is giving you broader exposure to high dividend paying companies in the United States. Right now, at the time of recording this video, it's paying around 4% a year in dividends. Again, the whole idea behind investing in an ETF as opposed to one company is now your work is less because you don't have to keep up with the stock every single day. You don't have to worry about one company going bankrupt. And it's managed by the fund. That way you can just keep working to put more money into the fund. Category number 2 is international dividend paying ETFs. This is a fun one because if we look at the companies overseas, some of these companies are not only growing quickly, but they're also in markets, countries that are also growing. That means some of these companies have the ability to grow faster and pay out bigger dividends faster. But it comes at a risk, because some of these countries are not as stable as the United States. Some of these countries could see more unrest. A couple examples here will be VYMI. Again, disclaimer, this is something that I'm personally invested in. This is a fund created by Vanguard that's investing in high dividend paying companies internationally. Another example is IDV. This is an ETF created by iShares. It's a different fund manager, and this is their Select International Dividend Fund. At the time of me recording this video, VYMI is paying around 4% a year in dividends, while IDV is paying around 5% a year in dividends. And then we have the third category, which are the real estate ETFs. Now, I want to remind you that for those of you that are investors and you want to stay up to date on what's happening in the financial markets, my team at Briefs Media publishes a free daily newsletter called Market Briefs, where we break down what's happening in things like the economy, housing, stocks, crypto, and the global markets into a fun, witty, and easy to read newsletter. We have hundreds of thousands of investors that read Market Briefs every morning. Plus, when you sign up for Market Briefs, you'll also get my investing masterclass as a bonus, where I will walk you through how you can get started as an investor and find hidden investment opportunities before everybody else. All of this is completely free. So if you want to get Market Briefs and my investing masterclass, all you have to do is click the link down in the description below. REIT stands for Real Estate Investment Trust, and this is where you're getting exposure to the real estate market without actually going out and buying the properties yourself. Now, there's a couple ways that you can invest in REITs. One type of REITs are real estate REITs The other kind are mortgage REITs. A real estate REIT is where you're investing into a company that's actually buying property. Whether it's apartments, offices, hotels, it's buying actual physical property. A mortgage REIT is where this company is going out and investing in the mortgages, the loans that are backing the real estate. Here's a couple examples. VNQ is a popular ETF created by Vanguard that will give you exposure to the real estate REITs. These are companies that are actually buying the physical properties. REM is a REIT ETF that gives you exposure by iShares to the mortgage REITs. Right now, at the time we recorded this video, VNQ is paying around a 4% dividend a year, while REM is paying around 9.5% dividends a year. Now, the 9.5 number is going to look very attractive, but it's also a much more volatile market. So, when you make your investment decisions, when it comes to dividend ETFs, the one factor you don't want to make your sole decision off of is the dividend. I get it. You're investing for income, but you have to look deeper than that. Understand what is the assets that you're investing in, because you can get a high dividend, but if the asset is crap, then the value of your asset's going to fall and your dividends will fall with it as well. That's why you want to make sure you're investing in good assets that are paying strong dividends. That way, hopefully, the assets will grow and the dividends will grow with it as well. Asset number 3, a little bit more advanced, is to invest in real property. Just like everything I've talked about in this video, there's multiple ways to do this. You can go out and buy rental properties yourself, or you can go out and invest in somebody else's deals. This is generally called syndicate deals, sometimes called crowdfunded deals, where you're investing money but you're not doing any of the work. For the purposes of this video and this example, I'm going to focus on you buying the real property yourself, which means you're going out and you're buying property. For the purpose of the example, let's say a single family house, but you're not buying it to live in, you're buying it to rent out to another family. That way they pay you rent. And if you do it correctly, that rent is going to pay for your property taxes, your insurance, your maintenance, your management fees, and your vacancy, and put some money in your pocket every single month. Now, there's a few things you have to understand about real estate investing. The first thing is why real estate investing is so powerful. And this is me telling you as somebody who's been investing in real estate for more than a decade and as a licensed attorney. The reason why wealthy people love investing in real estate is because, number one, you can create steady cash flow, because as you work to acquire more properties, each property, if you do it right, will put more money into your pocket every single month. Number two is you own a hard asset. When I own a property, I own the bricks. I own the land, I own the windows, I own something that I can see, feel, and touch, versus with the stock, I just get a piece of paper saying that I own something, but I don't actually have a real asset. And number three is you get tax breaks. As a licensed attorney, who is not your attorney, what I can tell you is that real estate has some of the biggest and best tax breaks that a tax code has to offer. If you make $1 million a year as a doctor, you're probably going to pay half of that, or around $500,000 in taxes, depending on what state that you live in. When you make $1 million a year as a real estate investor, you could potentially pay $0 in taxes because of the depreciation deduction, because of accelerated depreciation, because of something called ordinary and necessary. I'll explain what all this means in just a second, but essentially you have the ability to make more money and pay a whole lot less money in taxes legally. Let me show you how it works. Let's assume you find this 3-bedroom, 2-bath property on sale for $200,000. Now, if you're saying, well, Jaspreet, where in the world am I going to find a property like that for $200,000? Well, maybe you got to look in a different market, because in Metro Detroit, you can find these types of properties all day and night long. You buy this property for $200,000, and let's assume that you can rent this property out for $2,000 a month. Now, here's the key. You're buying this property not to live in yourself. You're buying this as an investment to rent out to somebody else. That's the main difference, because when you buy a property for yourself, money is constantly coming out of your pocket. When you buy this as an investment, you're buying this to create a new income stream. So now, here's where the magic happens. You rent it out for $2,000 a month, but you have expenses. You have to pay for your property taxes. You have to pay for your insurance. You have to pay for your maintenance on the property, because sometimes the toilet's gonna break. Sometimes the roof's gonna get old. You have to pay for the management fees, because I don't want you to be the person that has to fix the broken toilet. I don't want you to be the person to get the call when the roof is leaking. There are property managers that can do that for you for a percentage of the rental income, and you want to factor that in there as well, because even if you're managing the property yourself, you should pay yourself. So always factor in a management fee, and I never manage any of my own properties because I got a business to run, I got other things to do. And then you want to factor in a vacancy cost as well, because the reality is tenants move out And when you have the tenant move out, there's going to be time before a new tenant moves in. So you're going to subtract all these expenses and you want to have money left over. Now, there's a few ways to buy the property. You can buy this property all cash if you have $200,000 in your bank account. You can buy this property with a mortgage, meaning you're going to put down 20, 25, 30% and then finance the rest. Or number three, you are going to go out and pool money together from a group of investors and you're going to all share equity in the property, which means essentially you're buying the property all cash. You're just getting the cash from investors as opposed to a bank. But here's where you have to know your numbers. This is what is going to give you what's called your NOI, net operating income. And you need to know the numbers. If you bought this property all cash, what type of returns would you be getting? So let's assume that hypothetically, after paying all of your expenses, you are making $10,000 a year in profit because you're renting it out for $2,000 a month. You have $24,000 a year of potential rental income, minus all of your expenses, you're left with $10,000. Is that a good return or a bad return? And the way that you do this now is you take this $10,000 number and you divide it by your cost of acquisition. Your $200,000 that you put down. So you do the math, $10,000 divided by $200,000, that equals a 5% return, a 5% distribution, a 5% cap rate, a 5% cash on cash return. A lot of terms for the exact same thing. But what this is telling you is if you bought this property all cash, you're gonna get a 5% distribution in cash in your pocket every year. Is that good? Is that bad? And this is going to be up to you. For me, this is not good. I like to see a 7% cash on cash return to make it worthwhile for me. So if I'm investing $200,000, I want this to be $14,000 a year. Now you might say, well, Jaspreet, that's really hard to find. Yes, it is in today's market, but it's not impossible. Because even in 2021, I like to tell this story because, well, 2021 was one of the craziest housing markets of all time. It was one of the hottest housing markets of all time where every single property was being sold way over asking price. It was impossible to find a deal. But even in 2021, I was able to find deals. Did it take more work? Yes. Did it take more time? Yes. Did I have to walk through more deals? Yes. But I could still find deals in 2021. This is where I want you to understand real estate is a good industry for people that are willing to put in the work. There's a funny saying in business, I'm gonna say this again in this video. How hard could it possibly be? That saying online has humbled more people than anything else in business. It is hard, but if you're willing to put in the work, you can see amazing returns if you're willing to go through that hurdle. Now, this is where things really start to get fun because let's assume you do have $10,000 a year in income. You generally would have to tell the IRS, hey, I made $10,000, so I have to pay taxes on $10,000, but with real estate, it's a little bit different because with real estate, you get to first file what's called a depreciation deduction, which means you get to tell the IRS, hey, my property is 1 year older, and because it's 1 year older, I deserve a tax break on my property. So in this example, I bought the property for $200,000. Let's assume $30,000 was the value of the land, $170,000 was the value of the property. That would mean that I would be getting more than a $6,000 write-off every year just because my property is 1 year older. And if you're wondering how did I get to the $6,000 figure, you can watch some other real estate investing videos to see how you actually calculate this depreciation number. This is doing the most basic depreciation offered by the IRS. Then you can go on and take even more tax breaks, kind of like ordinary or necessary. For example, if I need a cell phone to run my real estate investing business, well, I could take some of that as a write-off because I need a cell phone. It is ordinary and necessary in order for me to run my business to lower some of my tax liability, which means, yes, I can make money kind of passively. It's not fully passive, but kind of passively, and pay less money in taxes legally. But this is where you want to get a good accountant to help you out with that. Asset number 4, getting even more advanced, is a business. I'll just give you a personal story. Many people know me because of my YouTube videos on minority mindset, but the reality is minority mindset is not my full-time job. This is my hobby. My full-time job is I am the CEO of a company called Briefs Media, BM. But not only am I an employee at Briefs Media, I'm also the owner at Briefs Media. And this is where things get very interesting because there's the difference between being an employee at a company and being the owner in a company. So let's give some hypothetical numbers. Let's assume Briefs Media makes $1 million in a year from all of our operations. Then we have, let's call it $600,000 a year in expenses. That's our salaries, our software, our rent, and everything in between. That means we have $400,000 a year in profit. Who does that profit go to? Well, this profit goes to the owners of the company. In this case, it's me. Now, Briefs Media is a little bit unique because we also have a profit share system in our company where some of our profits are distributed with the employees as well because I am the only owner. However, generally the way it works is profits go to the owners only. And this is where things get fun. There's two ways to go out doing this. Number one is you can go out and start your own company, which is very difficult and a lot of fun for the right person. Some people are gonna hate the idea. In fact, most people will probably hate that idea, but some people will love it, which is fine. But the alternative for, again, some people is you might be interested in going out and buying a business. There's a lot of businesses out there that you can purchase where now you get your share of the profits. Again, there's a difference between working in the company. As a CEO, I get a salary, that's right here, but there's a difference between that salary and the profits. Profits go to the owners. Owners don't always have to work in the company. But to make this work, there's a couple things you want to know. Number one, in many businesses, especially smaller businesses, you are going to have to work in the company in order for the business to work. That's not a very attractive offer if you want to be passive. If you really want to be truly a passive buyer, you're going to need more money. We're talking about hundreds of thousands of dollars and sometimes millions of dollars just to get started, so you're aware. If it's smaller than that, you're probably going to have to work in the business in order to grow the business so you can eventually fire yourself as the CEO or whatever position you are in the company. Number two, you want to find an industry that you can either work in and succeed in or want to work in and succeed in. Building a business is hard. I talked about this just a couple of minutes ago, but there's a saying in the business world which goes, how hard could it possibly be? That line has humbled more people in business than anything else because business is hard. And if you are getting caught up in the excitement on the internet of people saying, just go and buy a car wash, buy a laundromat, buy this, buy that, well, it's pretty hard to make money in any business and keep sustaining that profit and growing the profit if you're not willing to put in the work. So if this is something that you're thinking about, great. There's a ton of potential. You can make a ton of money. You can see a ton of success and a lot of fulfillment doing it, but you gotta be willing to put in the work. If you're not gonna put in the work, you are not going to see the return and that business will die. And asset number 5, which is technically not the most advanced, I just kept it number 5 because this is not something that I've ever done before, is peer-to-peer lending. And what this means is instead of you lending your money to, say, the United States government, you're gonna lend your money to somebody else who maybe wants to go out and buy a rental property. Maybe they wanna buy a car. They need some sort of personal loan. You can go out and lend your money to that person. Now, this is difficult if you do this by yourself, but there's a lot of services on the internet right now. I'm not sponsored by any of these companies, but you can go online and find a bunch of peer-to-peer lending companies that can help you find different ways to lend your money to people. It's called private credit. And the way it works now is you're gonna lend your money to somebody who needs it. Now, ideally, my personal suggestion, as somebody who's never done this before, is I would wanna lend money to somebody where it's backed by some sort of collateral. Ideally some sort of real estate, because if they default and go bankrupt, you want to have some way to at least get some of your money back because there's a chance that they will not pay you back. I mean, that's the risk as an investor. Now, the nice thing about this private credit market is sometimes the interest rates can be pretty high. I mean, 5%, 10%, 15%, I've even seen 20%. But you guys also remember, if somebody's paying you 10% in interest, they got to be making more than that. Now, is it possible? Absolutely. You see it all the time in real estate where real estate flippers are going to pay more than 10% in interest to borrow their money because that's just how the real estate hard money lending game works. But if you want to get involved in that business, that's a potential for you to create another income stream. But just like anything else, it's not easy. You got to be willing to put in your work. I don't have personal experience here, so I can't tell you how to do it. But I've heard of people doing it, and it's something that you can consider as another way to create income from the money that you already have. And with that, I would like to hear from you. Which of these 5 assets, Treasury Bonds, Dividend ETFs, real estate, businesses, and peer-to-peer lending are you most interested in? Let me know in the comments and tell me why. I'm looking forward to hearing what you have to say.
I would love for you to share first, how do you think that institutions profit from our financial uneducation?
Well, I think the system, our economic system, is designed
to keep the majority of people poor. After learning about how money works, you start to see why certain things work the way that they do. I'll explain exactly what I mean.